Service. All right, Chanel, I'm gonna let you get the floor.
Thank you so much, Anne. Hi, everyone. My name is Shan-Nel Simmons. I'm going to do an introduction within my presentation, but I am going to do what I do best, and that's talk taxes. So definitely take notes, get ready, and I'm going to leave some room at the end for questions. So if you want, you make note of any questions that you have. While I'm presenting, also feel free to put your question in the chat because then I can maybe check it later and then answer those questions too. So, all right, we're going to get right to that. Let me go ahead and share my screen. Let me know. Let me get some thumbs up if you all can see.
Yeah.
Awesome. Thank you. All right. I'm going to go ahead and go straight from the beginning. All right. So today's presentation is going to be taxes for new business owners. And really quick disclaimer, just letting you guys know that this presentation is going to be general information and educational purposes. So, this I am a tax professional, but what this presentation does is it just gives you the general information. This is not going to be something that you can necessarily apply to your particular business. Is not to give you actual guidance on your business. However, if you do want to receive official tax guidance from myself, I'm going to provide that opportunity at the end of this presentation to show you how to contact me if in fact you want to get a consultation. But this presentation doesn't actually provide official tax and legal and financial advice. This is just very general so that way you can get an idea. All right, so we're gonna go jump right into this. And the number one question a lot of people have is they'll say, how did Amazon pay zero taxes? Right? They're like, I hear all of these corporations and businesses out there and they pay no taxes. And is that something that's available to me as a small business owner? Or is there any way that I too can operate a successful business and avoid taxes? Well, the way it's done is Amazon and the bigger entities, what they understand best is they understand their business entity type. That's where it starts. And so they make their plans in accordance to their business entity type. And then they also take advantage of every and all tax breaks, credits, and deductions that are available to them. Before they even start their business, they keep outstanding records. And then they use a tax professional on their team. So a lot of those businesses, they'll have accountants and bookkeepers, and then they'll also have tax advisors and tax accountants that are specifically just focused on the tax code. So all of these options, it may sound like, okay, that's the big guys. Is that available to me? Absolutely. And I'm going to show you how. So again, hi everyone. I'm Chanel. And as I said, I am a tax expert. I'm also a former IRS revenue agent. I've won some awards as an entrepreneur, and my company actually turns 5 this year. So I'm really excited about that. But I've been doing taxes for almost 20 years. I've been featured as an advisor in HuffPost and Credit Karma. I'm a published author, and I am a wife of 15 years and a mom of the most funniest 5-year-old. She is 5 going on 50. Just pray for me. Okay. We're gonna keep going on that. so so as a new business owner, the types of taxes that are available to you as or that you will be responsible for as a business owner. You will typically pay income taxes. That's the one that everyone's pretty familiar with. You're used to filing your 1040 and you either get a refund or you end up paying a little. You'll pay employment taxes. So even if you don't have employees, you typically are employing yourself. So if your business is successful, you will pay self-employment taxes. And we're going to really dig into that. You'll also pay the employer's portion of Social Security and Medicare for any of your employees, as well as unemployment taxes for any employees and workers that you may have. If you sell products, and sometimes now, especially after the court ruling about Wayfair, use tax it can be not only for just physical products, sometimes digital products too, or the amount of sales that you do within a state. So you have to be very careful about sales and use tax now, because it goes beyond now just if you're physically within a state. It can be for if you do a substantial amount of transactions within a state. So when you're first starting out, most people, except for those they call unicorns, which means like, you're very lucky. You went from having $0 to maybe like 500,000 to 1 million overnight. And I'm not going to say that's not possible, because all things are possible when you're an entrepreneur. But most companies, when they start off, you usually grow your money gradually. And so typically, if you are selling any kind of product, even if you're predominantly service based, you really want to be careful about what your sales and use obligation is. I'm going to just give a real brief example of that. Someone who's maybe a speaker, your service is that you speak, but you might also sell books. So depending upon how those books go out, if Amazon is shipping them to your clients directly, then Amazon is going to be responsible in collecting that sales and use tax for you and paying it on your behalf. However, if you're buying it wholesale from whomever's your publisher, and then you are selling it to the end user, whoever's purchasing it, because you are selling an actual physical product, you most likely will be responsible for collecting the sales tax and then reporting it to the state where that transaction happened in. So I'm assuming most of us here are from Maryland, probably DC. In the chat real quick, just want to see who's from where. I know we got Maryland, definitely. Okay, Maryland. Thank you, Pam. Rhode Island. Hi, Misty. Maryland. Okay, but you live in Maryland. Okay, Maryland. Okay, so yeah, so it seems like pretty much everyone here is subject to that 6% sales tax. Yep, live in Maryland. Awesome. And most of you probably, because you live here, you probably plan to do business here in Maryland. So with that said, if you're physically selling your products wherever you are, you're going to be subject to possibly reporting sales or use tax. But remember what I said at the beginning, particularly when you're outside of the state where your business is physically located, it might be subject to how much you're selling. So I don't want you ever to feel overwhelmed about that. That is definitely something that you would want to get with a tax professional, just to make sure what is your obligation is when it comes to whatever products that you're servicing. And don't think just physical products, digital products now, especially in this day and age, more and more states are starting to really hunker down on that. So you really have to be mindful. Every state has something different when it comes to sales or use tax.
Okay, so I have a question that came up in one of the orientations. So there was someone who had started their business in another state like Delaware, because they were told, the traditional thing like 10 years ago, that they told everybody, hey, you need to start your business in Delaware or start your business in New Jersey because of tax reasons. Can you speak briefly on some of the pros and cons of doing that? Because I just want to make sure everybody understands that, having your business in another state may or may not be the best thing depending on what you're trying to do, right?
Okay, and I see a few questions, so I'm actually going to hit on these questions in real time. So since there's so few of us, we're going to treat this, I'm going to still go by the PowerPoint slide, but we're going to kind of go conversationally at this point. So Ann, to answer your question, when you decide to incorporate in another state that is typically tax friendly, so Delaware is friendly when it comes to income tax, meaning that if you took your total amount of income that you received and you minus the expenses, and then if you're left with positive income, meaning that you have more income than you have what you spent, then that amount that would be like taxable income would be subject to an income tax in most states. Delaware, states like Wisconsin, Florida, Texas, a lot of them do not have income tax. However, because of the fact that they know that a lot of companies try to get around this loophole, they do have what's called a gross receipts tax or something similar to that. So what they'll end up doing is, depending upon how much your gross receipts are, you may end up paying a tax on that amount. So all because you decide to go to another state and you're trying to avoid one tax does not mean that you might avoid taxes in general. They just may have a different kind of tax. And like, I'm going to get down to the end of this list to talk about Maryland specifically. Misty, real quick, I want to hit on your question about employment tax real quick. So with contractors, we're going to talk about that. I have a whole spill for independent contractors later in this, but, or just employment tax in general about you as an owner, workers, etc. But just to hit on that, when it comes to independent contractors technically pay, they are their own business. That's the whole reason why you're doing that. But I would love to do that as a total. I have a whole other presentation for that when talking about employees versus independent contractors. That's something I would love to possibly, I'll talk with Ann about possibly coming back to maybe do that as another day, because that's a whole conversation. But just to sum that up, first you have to make sure that you're treating the person correctly, your worker correctly, and making sure that they are in fact a true independent contractor, and you're not just filling out a 1099 in hopes to avoid the employment taxes or to try to keep your costs down, because we're going to talk about that as well, Kim Marie. All that's going to come, all that's later, I promise. We got a whole lot of slides. We on slide 6. Can we be independent contractor? We're going to talk all about that in a minute. Okay, and then I really want to real quick, because I know we have a nonprofit here. Hi, Katrina. So yes, Katrina, you in general as a nonprofit, as you know, typically whatever you receive for contributions for your nonprofit as a cause, that's going to be not taxable. You just have a huge filing requirement that you have to file. However, when you have unrelated business income on a lot of forms, it's called UBI, you'll have unrelated business income tax. And therefore, let's say that a part of your program is to provide, let's say, a service of, I don't know, let's say you're doing cleanups. So you go out in neighborhoods and you clean up and everything. Wonderful. And then one of the things that you decide to do is, in addition to the cleanup, maybe you guys have like a special book about cleaning up your soul. It's something totally isn't in relation to, but it's really not the core part of the business. It's just a way to bring in money. That book could possibly be subject to income tax because it's not really the core part. And again, that would be something that you would have to get with a professional. So I want you to kind of, for you, Katrina, when it comes to a nonprofit, just think about that and just, you can dig more into that. It's called unrelated business income. So there's like a whole laundry list, but just think in regards of when it comes to nonprofits, you have a core cause and a core mission that you're working on and that you receive contributions for, specifically for. And when the nonprofit decides to sell certain things and collects money for that, that's when those items could be possibly subject to not only sales tax, but also employment taxes and other taxes as well. That's a whole thing, but I know that's something very special to you. So we're going to move on real quick. I'm gonna get out of the chat. This is what happened when you scrolling. Okay, so property taxes. So this is property taxes just like a house. Like, so think of anything that, like, if you happen to actually own your building, you're not renting it, and just like a house, if you have commercial property, you will be subject to property taxes. So that would be another tax that you would have to think of in your budget. Excise taxes, that's more towards people who might decide to get into like commercial trucking, and you're dealing with like fleets of cars, or if you have tanning, like tanning salons, fishing companies. So like us being here near the Chesapeake Bay, sometimes some of them will be subject to an excise tax. So those are very specialized tax. So depending upon your industry, you may be subject to that tax as well. And then Maryland has this wonderful tax that everyone absolutely love to pay, which is the personal property tax. That's the one that whenever you hear people say, oh, I got to pay the $300 for my business, that is it. What that is for is that is in addition to that's keeping your LLC in good standing, or whatever business industry entity structure you have. So it's not just for LLCs, it's for C Corps, it's for partnerships, it's for S Corps, it's for whatever business entity structure you have. If you do not file that and submit the fee, then that's when it will no longer be considered in good standing with the Department of, I want to say it's Tax and Assessments, that has that with Maryland. I see the chat is going off really quick. Let me see. You're not paying. Okay. All right. So we're going to move on. So to answer your question, Coastal Life, the most popular entity type is an LLC. It's popular. Is there anyone that is better than the other? The answer to that is no. In truth, no. They all have their own purpose. That's why they all exist. But the reason why LLCs are so popular is simply because you get a form of legal protection and you get a huge flexibility in how you can tax it. That's all. For the ones who are savvy enough. The other reason why it's popular is just because people chit chat and I have an LLC, so you should get an LLC. so, but for the people who are very strategic and understand the differences between business entity types, the reason why LLCs are typically very popular for those who just start is simply because of the fact that it gives you like I said, a legal protection, and it separates your personal from your business legally. That's one of the legal advantages of it. But for tax purposes, you can tax it in so many ways. So, and people are shocked that LLCs itself is not a tax selection. So there is no LLC tax. That's not a real thing. But what is real is this: when you are a single member LLC, when it's just you, you're the only owner, by default, you are taxed as a sole proprietorship. And it's called a disregarded entity. That's when you will see the information on your personal tax return. And that's when you'll include it just as an extra form on your personal tax return. If you decide, this is for tax purposes, legally you will remain an LLC, but just for tax purposes, if you decide that it's in your best interest to be taxed as a C corporation or an S corporation, you can make those elections with the IRS, and the IRS will have to approve it. There's a lot that goes into that. Particularly with S corporations, you have to make sure that all of the shareholders or all the members of the LLC who will be shareholders for the tax purposes are domestic, meaning that there's no one as foreign. They're domestic citizens. They are citizens of the United States. You can't have any more than 100 shareholders. So if you ever decided, like, I wanted to get a whole lot of people to come in, then you would have to keep it under 100 people. And considering that the world is now a very global market, that might not be something that you want to do. Keep in mind, one of the things I love to just let people know in general, how you start is not necessarily how you finish. So when you do start your business, you are not forever an LLC. As you grow, you will constantly keep making the decision and keep looking and trying to decide right now, based on maybe tax law, based on whatever contracts you're trying to get, or whatever customer you're trying to provide, whatever owners that you might try to do, long-term financial, personal and business financial goals, multiple reasons why you might sit down or have a conversation and a consultation with your financial team and figure out which is the best entity type. You are not stuck to any one at any particular time. And before I talk about multi-member LLC, I'm going to see what's going on in here. You're welcome, Coach Life. Let's see, what's the difference between the two? The two what, Marie? Did I miss it? Okay.
But no, Shan-Nel, you didn't miss it. So basically after your presentation, I
Okay.
have a whole lecture on the different type of business structures for the class.
Oh,
So
okay, cool.
we're going to be going through that and giving them
Awesome.
full attention because I want to make sure they all understand what business structure is.
Perfect. Awesome.
Yeah.
So, and it's good that Ann is doing that, simply because of the fact that you have to understand the different business entity types on their own. In this presentation, the next slide, I'm about to talk about the pros and cons of a sole proprietorship. And the reason why I'm gonna do that is because I feel like sole proprietorships get a really bad rap, and there's actually a reason for them. There's a reason that they exist. But real quick, I just want to point out, if you have a multi-member LLC, that's because you have 2 or more owners in your LLC. And then by default, that return will be filed as a partnership. There is one exception to that if you're husband and wife, and both partners have to be active in the business. If both of you, as husband and wife, are active in the business and you file a married filing jointly return, you can file what's called a joint venture. And literally all that is like with the single member LLC, you would just file a part of the personal return. It's the same form. We're going to talk about that form later, but that's the only time when there's two owners for the LLC that you don't have to file as a partnership. You still can, because it's still the default election, but you can decide if you're married and you're filing married jointly to go ahead and file on your personal return together, as long as you're both active within your business. And then again, same thing as when it's just you, you can make the election of being taxed as an S corporation or a C corporation. Legally, you will still remain as an LLC. So, okay. So in general, in life for business, just in general in life for business, doesn't matter what entity type you are, you always want to keep your personal separate from your business. Always. Just in general. That's just a general rule of thumb. Just keep personal separate from business. Does not matter. Entity type. So answer the question. I kind of talked about this before, but I'm gonna reiterate it. It really depends about your first you. What are your goals for your business? What do you see for yourself financially? Some people know that they want to eventually one day have a business that's going to grow and have other partners. They don't want to be the only owner one day. They want to maybe have a whole board that takes care of everything. So eventually they know I'm gonna start here, but I'm gonna eventually grow this thing to something else. Other people are perfectly fine with having it being very simple. They're like, if the day that I happen to pass on, if no one decides they want my business, it can end with me. I'm fine with that. Same thing with your business goals. Depending on what you want for your business goals. I tell people all the time, define your own success. So what's successful for me may not be what's successful for you, and vice versa. You may have a certain a revenue point or profit point that you want to do. You may be like, I just want to be local. I just want to be regional. You might have global aspirations. You may not. It truly all depends. And the most important one is, how complex and how easy do you want your taxes? If you're like, I don't mind how complex it is because I don't even plan to do it, hey, there's a whole lot of things that can be done for you. But if you're like, nope, I want it easy as pie, I want something that's I can follow, maybe even do on my own, then there's options for you as well. But as far as which selection is best for you, it truly just depends on your overarching goals. And that's why consultations are so important. All right, let me see what's going on in the chat. Would you file your income? I did in the past.
So basically what I said, Shan-Nel, was that Pam had a question about filing separately when you're filing as a sole proprietor. And so my answer to her was, yeah, I mean, before I became an LLC, when I was a sole proprietor, that income gets passed on to my 1040 because it's part of that business schedule that I had to file, and then I filed separately. I still file separately to some extent, even as an LLC, but you just have to, it again, like she said in the slide right here, it depends on your financial situation.
Right. So, and I'm gonna show you the form. So I think once you guys see the form, you'll better kind of understand how it's actually allocated. When it's you and it's just you in the business, it's already going to be tied back to just you. Like everything about your business will show that if your spouse is not a part of it, that it's solely about you. You could technically still file married filing jointly for the personal tax benefit of that. And if for some reason something came up financially or whatever. I mean, like if you're worried about, whatever, there's a whole other thing we could talk about, which is innocent spouse, injured spouse. But you could still file married filing jointly because, and when you guys, I think once you see the form with the Schedule C, and see how it is truly a separate form, it is called your business return. It's already separated from all activity of what's going on with your spouse. The only thing is that the bottom number comes over to the individual part, and now that part is, for income tax purposes, is taxed with your spouse. The self-employment part, though, is allocated just to you. So let's see what's going on in the chat. Oh, you're welcome. All right. So, and yeah, this is just reiterating that single member LLCs are taxed as disregarded entities and it's taxed like a sole proprietorship. So, what is the pros of a sole proprietorship? There's no double taxation. What double taxation is with a corporation, a C corporation is taxed on its own return. So if it's profitable, it's taxed on its own return. And then if you don't have any investments, or like if you never contributed to the corporation, depending upon how much your dividends are, those can get taxed at the capital gains rate. So that's a whole other discussion. But when you take money out of the profits after it's already been taxed on the corporation as a shareholder, then it can get taxed again on your personal income tax return when you are not a sole proprietorship. But when you are, you don't have to worry about taking, when you take out the profits, it's only taxed one time. So that's the reason why people say, paying yourself from your sole proprietorship or your disregarded entity, if you're LLC, is owner's draws, and it's literally taxed once. So if you have any losses, it can reduce your total tax bill. Again, I think once I show you the return, you'll see it and you'll see how that plays out. But because of the fact that income and losses get transferred over and added in with all your other income sources, like if you have W-2 wages still, interest income, or any other income sources, if you happen to have a loss, it's going to reduce your total income and therefore reduce your income taxes. Again, you'll see it. No separate tax return. So it's not a whole other return like a partnership, like an S Corp, or like a C Corp. It's just an extra form within your personal tax return, but that form, the Schedule C, is treated like your business return. So that's why a lot of times you'll hear banks and lenders and such say, I need to see your business return. And they'll say, provide me with the Schedule C. That's what they're talking about. It's a part of your personal return. All the profits belong to the owner only. So if you have more income that came in than the expenses that you paid out, what's left is yours. You don't have to worry about splitting it up with, shareholders and investors. It's just yours. Like, you're the owner. There are no shareholders, there are no investors. It's whoever is the members of, if there's multiple members of the LLC, then it be split amongst you guys, however you decide to do it. But sole proprietorships is that's the whole point. Like, that's a partnership when it's more than one of you. So when it's just only one owner, it is just yours. You don't have to worry about splitting it with other people. It's like, that's my money that's left over. So that's always fun. It's easier to create, operate, and dissolve. I'm gonna tell you how easy it is to literally open a sole proprietorship. If a little kid went out today with a pitcher of some water and some lemons and had a table and a sign and said, buy my lemonade, they are officially a sole proprietorship. That is it. No paperwork, no anything. The moment that you say, I am ready to open up for business, you are a sole prop, period. You can register if you want to. It makes you feel good. But the moment that you say, I'm available for business, is not the first time someone pays you or anything. The minute that you say, I am available for business, you are a sole proprietorship. It's easy to operate because it's just you. You can hire as little or as few employees as you want. So it's really easy to operate and then to dissolve. When it is just you, anything that's left will go only to you. And if in fact you happen to pass, unless you have directives like in your will or such, um, the business dies with you. That's it. And then there's no balance sheet required with filing the tax return. You may want to keep a balance sheet for other financial reasons though. Um, and then the cons. There is self-employment tax on all the net profit. So again, going back to the example of more income than the expenses that you spend, um, you will pay taxes on what's left over on all of it. When you have other entity types, you typically can pay yourself a salary, and therefore they're not the salary portion is getting the self-employment tax, which I'm going to break out for you to show you what that is. So I think it'll make a little bit more sense. But the net profit at this time, all of it would be subject to self-employment tax where when it's a sole prop. So that's kind of a con. And that's the reason why people say once your business starts making a lot more money, you might want to look at different entity types and start paying yourself a salary over in the other business forms for tax purposes, just to save you usually like 7.65% in self-employment taxes. It may not save you that much in income taxes, but it will save you potentially in self-employment taxes. Top corporate rate may be lower. So right now for individuals, the highest tax bracket is 37%. So I can make millions of dollars and end up paying 37% in income tax. For corporations right now, the highest percent is 21%. This is only for C Corps. So not an S Corp, just a C Corp. There's a whole lot more that goes into being a C Corp though. But with that, I literally would pay 16% less in income taxes. But also remember, like I told you, C corporations do have a double taxation. So you may end up paying close to the highest bracket. And these are for people who are operating at very high levels of profit that would have to make this kind of consideration, but that is a thought. No liability protection unless you're an LLC. So remember, like I said, with the kid who goes out there, who puts a lemonade stand out. If in fact someone got sick from the lemonade and they wanted to sue said kid, which is god awful terrible. I'm like, it's lemonade, right? They usually sell it for like $1 at most, right? But if they wanted to sue them for it, what would end up happening is they could come for the kids' toys. Like let's say the business was all worth of maybe $20. That's all they put into like, putting their little table out and all that. And their little, maybe their little changes in there, like $20-$30 at most, right? But they could be like, I want to sue this kid for like $1,000 and come after their personal assets. So as a kid, I mean, most kids don't really own anything, but they could. So, and that's the same for you. They could come after your personal assets if in fact they were upset about something, unless you're an LLC. Just as a bug in your ear, letting you know, this can also, you can still operate as a sole proprietorship though. And especially when you're first starting off, remember I told you about the $300 for Maryland? Talk to some insurance people, because that's the way you kind of can still protect yourself and maybe at a lower price, and without having to be an LLC. Just a little bug in your ear. Again, talk to someone in insurances, and also too, depending upon your industry, it just may make all the sense. So like if you're someone that's like in healthcare or it's in an industry where it's kind of likely someone might put a claim against you for something that you're going to do, then you may really want to look into having that extra layer. And again, sit down with an attorney and have that conversation. But
yeah, one of the things we're going to talk about in this class also, which we have Keith and Keith from Peak Financial also, in addition to talking about different types of business insurance, different ways that you can protect yourself even as a sole proprietor. And I think every business, I don't care what level you're on, should just invest the $30 to $60 for business insurance.
Absolutely. Absolutely.
In the class too as well.
Absolutely. So, there's other ways to do it. So, just wanted to let you guys know, don't feel like I have to run and make sure I'm getting all this other stuff done. Start your business, be the kid and put your stuff out there. But like Ann said, you know, there's other ways to protect yourself. And like I'm telling you too, there's other ways you can protect yourself, and definitely sit down. This is why I said you have a whole team. So start thinking about that too. This is like a sidebar note. You have a team that you have to consider. So tax professional, accountants, banker, lawyer, insurance. It sounds like a lot. It really does not necessarily have to be. Shop around, and if nothing else, just get some advice from the professionals, not the street chit chat. Okay. So the other thing about soap props are that, you know, unlike corporations, there might be less benefits. Corporations are allowed to have like other special deductions, and they're allowed to offer other incentives like stock options and cafeteria plans and such. So those are usually not available because you, as a sole proprietorship, because they just don't offer that or allow that on that level. You would have to basically upgrade your business to make that an offer. And then something I kind of said it several times, the business existence is tied to you. So if you're no longer involved, or if you happen to pass away, then the business no longer exists. So those are some of the cons to having a sole proprietorship. So this is the Schedule C form. Um, it never really changed. So even though that's 2018, this is like, I literally looked at the 2020 form. This is what it looks like. All right, what's going on in here? Should I get insurance on my clothing? I mean, if you want to, I can tell you right now, though, clothing, unless it's a uniform, is not tax deductible. So just word to the wise. Um, I mean, if you want to, and that would be something you would need to sit down to with an insurance professional. They can tell you if that's something that you need. Let's see what's going on. Yeah. So, but this is a Schedule C form. As you can see, I purposely had it where this lady here, and Annie lady, she's using her social security number. So this goes back to one of you guys' questions where you were saying, like, how do I keep everything separate? This is how they already know that this form and all the information on it is tied to just you. So even though you may be filing together, the information that's on here, and again, if you don't want to use your social, you can use your employee identification number too. You can get an EIN and use that instead. But as a sole prop, you will typically use your social security number. You can get an EIN as a sole prop as well, but if if for some reason you didn't get one, this is what you would use. But yes, this is how they know it is just you. This activity is your business. And if in fact you were married and you were sharing it together and you wanted to file, like I said earlier, as a joint venture on your personal return, these transactions would just be split in half, and there would be two separate Schedule Cs, one for you for this Annie Lady Business LLC, and one for your spouse if the both of you were involved in the business. That's a special circumstance. But typical, normal Schedule C, disregarded entity LLC in this case, or sole prop, as you can see, this would be basically how it would look at the top. Okay. For her, she had some gross receipts that year of 200,000 or so. We're gonna go down to the expenses. This is going down the form. She has some advertisement. Most of you guys, your stuff will never look this round. It shouldn't look this round. This is all by examples. But yeah, as you can see, there's all kinds of things that you can deduct. Commissions and fees. This is contract labor for those of you who had questions about, independent contractors. And then this is wages for if you decide to have employees. And then this is, total expenses. And then this tentative profit or loss, as you can see, all they did was take this number and subtract it from this 190. So for her, this was the amount that she had left over. Okay. And as you can see, they were saying this is the part that's going to go over to the front of the return and be subject to income tax. And this is the part that's going to be subject to the self-employment tax. So let me just look in here real quick. Okay, good. Thank you, Ann. So yeah, so this is just to give you a general idea of the form. So I'm going to assume most of you have worked a W-2 job before. Yes, nod some heads, thumbs up. Okay. So as a W-2, you only paid half of your Social Security and Medicare. So this is kind of an example of a paycheck. So this person, their gross pay was 73,000. They had this much withheld from Social Security and Medicare. This pay stub is from like Wisconsin, so that's why there's no state tax. but but um yeah, they had Social Security and Medicare, and this is their net pay. So that's what something similar to what you guys are used to seeing. But when you are an owner of your business, you're now paying both halves of it. So you going back to the paycheck example, if this was an employee, this is we're going to take it like their gross pay. But in this example, this is another Schedule C, not the one from before. After we went through everything, how much that person made, all of their expenses, their net earnings, what was left was at 73.62. It's the same as if it was a like as if this person's paycheck. So I want you guys just kind of wrap your head around the concept. And then what ended up happening was the self-employment tax, they took that amount and now it's 11,265, because it's literally these two numbers, this 4,564 and this 1,067 and change times 2. So as an owner, like I said, they're going to pay double. It's double the Social Security and Medicare versus when you are an employee. However, only owners are allowed to reduce all of their personal income though by half of that Social Security, so that self-employment tax. So I'm gonna show you. That number looks familiar again, right? That's the number that was up at the front or at the top with a pay stub, and at the bottom for the business, for the business owner. Top of the pay stub for the employee, bottom of the pay stub. This is how much that combined amount was for the employee, and this would be half of what the owner would have paid. What this has done is it brought down their total taxable income. So as a business owner, this is why this is so important to you, because this number right here, adjusted gross income, that number is used all throughout the tax return to help you in reducing your taxes and determining how much of a deduction you qualify for all types of items, such as medical deductions, such as if you have rental property, what is the threshold for you? There's just a pretty much every number and deduction that's on your personal income tax return. It is based off of that adjusted gross income. And we do everything in our power when it comes to taxes to find out ways to get this number lower. So if this was the employee, this number would be $5,000 higher. And what would that mean? That would mean that if they had a lot of medical expenses, they would have to have even more medical expenses in order to get a benefit from it. Whereas you as a business owner do not. So yes, you're paying a little bit more taxes, but having this business is going to help you put you in a better position to possibly not only lower your overall income taxes, but qualify you for higher deductions. And another deduction it also qualified them for, if you look right here on line 10, because they were profitable, this is 20% of that income, of that 73, that also helped reduce their taxable income. Again, something that would have not been available to the employee. So in truth, their taxable income was reduced by $16,000.
So, Michelle, Chanel, one of
Yes,
the
ma'am.
things I really appreciate about this specific point that you made is that a lot of small business owners don't realize the type of things that they can deduct, just the things that you talked about. So I know that everybody may not catch or understand all of what you said, but the
Mhm.
bottom line is that number one, this is why it's important to get an experienced tax professional. Number one, to help you understand what you're supposed to be able to deduct, right? Even I'm still learning. You know, when I had Chanel do my taxes, I've learned so much just by her doing my taxes, right? And so when you start to get your business and you start having all these complicated things going on, like your different business insurance, your fringe packages, your salary, and your unemployment, and your workman's comp, and all that kind of stuff, you're going to need someone like Chanel to help you understand what you're deducting and what your benefits are so you can reduce your self-employment tax. It's really important that even if you hire someone, not even, let's say you hired anyone or any kind of company, you need to make sure you understand what it is they're putting on your tax return that's going to affect you tax wise, right? So all this stuff, all this good nuggets that she's sharing, I'm glad that we're recording this because then you'll have an opportunity to go back and really look at this. And then you can actually, when you start doing your business and stuff like that, you can get Chanel to help you with your taxes once you start making money on a regular basis to the point where you need someone like her to help you with these type of things. So I want to thank you for sharing that because you just showed me something else different in here. I didn't even know. So I mean, I learn something every single time that she does this thing. That's why I think she's so awesome at it. But
Thank
just
you.
know that there's so many benefits of why businesses do taxes the way they do. And as a small business, you're going to be learning that as you go along in the journey of your business.
Thank you so much, Anne. So yes, so that's why I was saying that this is stellar and making sure that, yes, the previous slides I showed you, it's a little daunting. It says like, okay, I'm making profit, my business is doing well, but I'm showing out all these taxes for self-employment. However, when your business is doing well though, the government likes to reward those who are doing well lately by lowering your income tax. So unlike someone who would have been an employee, the only thing that they would have been able to reduce their taxes by would have been by the standard deduction or if they itemize. So they would have had $60,000 down here. That would have been, so that's like $20,000 more basically that would have been subject to income taxes that they would have had to pay on. So, and then on the flip side, remember what I was telling you in the previous slide, if your business wasn't doing well, how it could help reduce your other sources of income. If you look up at the top, line one is wages. So let's say you were working while you were building your business, right? And you had, let's say you were the $73,000 person, but then your business income was down here and it was a negative amount because it was the loss. You had more expenses than you had income. That too would have reduced this number down. Like it would have been whatever that number would be, it would have been lower and therefore lower your taxes versus you paying the full amount on your wages. That's why it's so important when I hear business owners say, oh, I didn't report anything because my business didn't make any money. You are leaving money on the table. So, whether your business is making money or not, you should always report. And I'm going to get more into that.
Yeah, one other point I want to point out too is that so here it is, year 4 of my business, and had my office and everything, and I had Chanel do my taxes. Okay, real story. I'm not ashamed to talk about it. When I first got my office, I spent a lot of money setting up my office. Okay, so I bought a conference table, chairs, video equipment. I had whole 9 yards. I had my desk. I had my phones. I spent more money just setting up my overall office. By the time Chanel did my taxes, I had a $6,000 loss. That loss actually went on to my pass through to my personal tax return, and I ended up getting almost all of that back
Mm-hmm.
as a deduction. Okay. So it can help you. And then what you do is you take that money and you reinvest it back into your business.
Absolutely.
Okay, so that so just kind of keep that in mind that if your business is having a loss, it's not necessarily a bad thing. It's just a situation of your financial status at that year. Okay.
Absolutely. So, again, when would you, as a business owner, pay self-employment? It's only on your net earnings. So, you don't have to worry about self-employment taxes if you have more expenses than you do income. You're still going to report that income, even if it's a dollar. You report the income because we're worried about making sure you get the benefit of your losses. But you would not have to worry about self-employment taxes on that. But in the years where it flips and you have more income than expenses, then that's when self-employment taxes will come into play. Um, and I basically broke down what net earnings was, again, your income minus your expenses. Um, and that's when it's positive, it's not a loss. People are shocked about this. The government want their self-employment tax on everyone, does not matter about the age, when they have a business. So for those people who are putting businesses in their babies' names, that's wonderful. And if their kid is doing really well online or wherever, great. Social Security and Medicare wants you to pay self-employment tax on their business income, and those who receive Social Security and Medicare themselves. So a lot of times, some people falsely assume, I am a Social Security recipient or Medicare recipient, I should not have to pay um, self-employment tax, because self-employment tax is all that is you paying the Social Security and Medicare as a business owner and as your own employee. But when you are a Social Security and Medicare recipient with business income, with net business earnings, meaning that you're doing well in your business while collecting Social Security, then you will be paying self-employment tax on that at that time. So that's just a little tidbit. So, and I'm so happy that you shared your story about the fact that, you having more expenses than and putting in all your money. Me too. When I first started out, I had put in tons of money into my business, knowing though that, and that's the reason why we're going to talk about the importance of record keeping too, knowing that I was going to deduct my startup costs. So startup costs are expenses you pay before the first day that you start your business. So this is advertising that you're going to open your business. If you happen to train any workers and you're paying them while you're training them to get them ready, those costs, any fees that you pay to any professionals for consulting or planning, any travel to secure customers or vendors. So I want to be very clear about that. Not just travel to just scout out locations, but securing customers or vendors. So this would be for those of you who, you might need to meet face to face with someone before you started the business. And that's just like going to be your first major client. And you had to fly out. That would be a deductible cost. Same thing for a vendor. For those of you who are maybe doing products and you had to get with the warehouse or so, and you had to, spend some money to go get with them to get everything started, those travel costs. And of course, any utilities, internet, or any expenses that you're using to run your business before it starts. So like right now you see me, I'm in my home office. So like I have the lights on, internet, all that good stuff. If I was just starting my business and I hadn't actually started yet, I would still be able to claim these. I would keep track of everything, because I need to have the lights and everything in order to get everything started. Like I'm using the internet to do everything, and using the phone, making those phone calls. So same for you, you would keep track of all that stuff. Startup costs, just startup costs. So this is remember, these are the costs and expenses that you're paying for before you say today is the first day of the company. You wouldn't be able to deduct interest expenses yet. You wouldn't be able to deduct any taxes that you pay. You wouldn't be able to deduct any research or experimental or developmental costs. That is its own credit that's done a separate way that would happen later once you actually start your business. But for startup costs, you can't do that yet. And then organizational costs, you wouldn't be able to deduct it as organizational costs, but I mean, as startup costs, but they have it where organizational costs is another kind of startup cost. So, and they do that separately. And I'm going to tell you the benefit why in a second. But this is the cost to form your business. So for those of you who do the registration of your company, to file the LLC paperwork, to submit the incorporation documents or the articles of organization. When you obtain those lawyers and or your accountants to establish the fees and to establish the business, any other filing fees. And if you happen, so like my nonprofit lady, if you happen to have a temporary directors while you're getting everything started, they're not going to be the directors for when everything opened, but they're going to be the directors for right now to get everything started. Those are organizational costs. Hold on, I ended up going too fast. So did I include the slide? Here we go. I'm gonna go back to the other slide. So what happens is organizational and startup costs together, you can deduct $5,000 up to $5,000 the first year that you decide to open the business. And they have them separate on purpose because combined, that means you can deduct up to $10,000 the first year you start your business. And if you spent more than that, then the rest of it over 15 years after the start of your business, you will be able to deduct that over time. But that's $10,000. That's basically keeping track of everything before you say my business is open. You would actually be able to make $10,000 up to, if you actually spent that much to start your business, you could make however much you spent and not have to worry about taxes because they're going to offset each other. And that's by you keeping track of everything. And you can only deduct everything once you actually open, which is why it is so important for you to establish your start date. This is why companies make such a big deal about grand openings. So I really want to really hammer in that you are in business the moment that you say you can purchase from me. Not when you get a client, not when you get a paying customer, or when you have more money versus the income. If your whole reason, so I want people to debunk this attitude of side hustle and hobby. No, even if you're working right now, you just have a business that you happen to participate in part time. That's it.
So
Period.
glad you said that. So glad you said that.
Period. You have a business that you participating in part time.
Right.
That is it. You do not have a side hustle. It is a business. It's just growing. It's developing. Treat it as such. You are going into it with the purpose of the fact that you want to make money. A hobby, a true hobby, is you don't care if you make money or not. You will still do it and spend your money for it. And if you just so happen to make money, great. If you don't, okay. That's a real hobby. Most people I see, you guys are getting ads, you're getting coaching, you're in classes like this today, trying to get what you need so that way you can be successful. You are in it for a profit. Even if you're not making a profit, you are in this because you want to make a profit. That's a business. It's just right now that you're just right now, you are working to flip it to go from being having a loss to being in profitable years. That happens.
Right. So Pamela has a question. She wants to know, would the application for a notary public seal, like if she had to pay to get her notary, would that be considered an operational cost or would that could be part of her startup costs?
Um, Probably because it's a part of a filing fee. I would probably put that under organizational.
Organizational? Okay.
Yeah. So,
Okay, and then the other question was, is there a time limit on certifications required for a startup? No, there's no time limit. If you have to get a small business certification for something, you can get that at, either before or after. That should not affect your startup costs at all because most small business certifications don't have any costs associated. Matter of fact, they're all free. It's just a matter of going through the application.
and the other thing I want to just bring to your attention about startup costs, and I know this firsthand because funny enough, and I think I told this to you. I think it's hilarious because it was like a year or two after I had started my business. Now remember, I used to work for the IRS. I think they felt some kind of way because I left. Because I used to be a trainer there and everything. Um,
Okay, so the next question is
yeah,
that can your
okay.
children have an LLC? Okay, what I would say to that is that there are child labor laws in place. So as long as your business is adhering to the child labor laws, that
Oh,
you are
um,
registering your kids in terms of child labor, that you follow the Department of Labor and Statistics on that, because what you don't want to have is penalties or potential jail time because you are hiring kids that are not adhering to the child labor laws. Okay. I was strongly advised, and we could talk about this offline, but that's pretty much outside the scope of what Shan-Nel is
yeah,
talking about right here. What you're talking about is actually hiring your kids to do work for you, whether you're paying them or not. And you have to be, make sure that whatever child that you are doing, that they're at of age and that they're following along the Maryland child labor law. Okay,
okay.
so
So because I'm seeing very people getting very specific. So I'm about to nip this in the bud real quick. For the most part, when it comes to business, Internal Revenue Code 162 of it all is as long as it's ordinary and necessary for the production of income for your business. Like if it's ordinary and necessary for your business, and then was it? Yeah, and then was it? Yeah, 212. Internal Revenue Code 212, and then you're doing it for the production of income, 9 times out of 10, you will be able to deduct it. We are not going to go through the whole list of what if, who, what, that's a consultation because everyone has special circumstances. So think about it in the sense of, is this something that you need to run your business? Is this a part of you being your providing your service to make money or to be available to make money? If that is the case, whatever that may be, then 9 times out of 10, you would probably be able to deduct it and include it.
right,
Worst case scenario, keep a copy of it and then let us professionals review it for you and we can make that final determination for you.
right. If you really think about some of the examples that Shan-Nel gave, if I'm getting let's say I went out and got because I do IT, and let's say I had an IT business. If I went out there and got a IT certification like Microsoft or Cisco, okay, that's an organizational cost because I'm doing that to better my professional skills. But is that necessary to operate the business? Absolutely not. Now, if I went out there and paid for training to train like a whole bunch of people and it's outside and I had to hire some people and all this kind of stuff, that might be more of something that I needed to do prior to the doors opening. I have to have them trained, bonded, whatever I have to get them to be before I open the door will be your startup costs. But if I, the owner said, hey, I have these three staff people and I think we're going to do project management, that's more of like an organizational type of cost. It's not something that's going to stop my business or cause my business not to open or operate. You know what I mean? So if you kind of look at those two examples that she gave, it sort of fits along that line,
Yeah. And
right?
so I didn't word the question probably answer.
Um,
It wasn't
yeah, and
what I
coach,
was
we'll
implying.
definitely get with that.
Okay.
If you have like specific questions,
Kitchen.
like Shan-Nel said, you could definitely like, have a
Yeah.
conversation and say, for my specific business, this is what I'm trying to do
Mm-hmm.
as far as my costs. And
Mm-hmm.
then she can tell you for your thing, what fits in what bucket so
Right.
that you can get it correct.
Right. So, back to the story of like, they actually audited my startup costs. I thought that was hilarious because it was a lot. My first year of business, I started in November of 2016. So I only had $600 of income. However, my startup cost was $25,000 and I had a whole bunch of different things there and to what it took to get my business started. And mind you, I do want to also bring this to your attention that startup cost doesn't have to be costs that you paid for during that tax year. It's literally the period. So think of when a restaurant opens. Sometimes it takes them a year or two, maybe even three, to actually get that ground together and build the building. Like depending on how into it they're doing to get the establishment going, it might take them a year or two or three or whatever to get it going. But trust and believe they're keeping track of every penny that's going into that before they decide to open the doors. And that's the same for you. As you are establishing everything that you are doing to get the company started and before you actually open the doors, you are to keep track of that. And that's what I did. As over the years it took for me to decide to open up my company, I did little things over time, had receipts for it all. And when I presented it, I got a no change report because I knew I had everything I needed to prove it, and it was for my business. I was able to keep track. I kept great records. That is available to you as well. Let's see. Oh, okay. So I just want to let you guys know, if for some reason you never started your business, like if you never, because like we're in this COVID day and age, so for some reason you were thinking about doing it and you never started your business, if this was before you actually did any action, like you were just fiddling around, but you really didn't do anything serious to start your business. So like sometimes people might travel to places and look at buildings and stuff, or they might have a conversation with someone, but they really didn't do anything to like really get into it. Like no websites were purchased, no ads, no professional, like they didn't really do anything. They were just kind of fiddling around with it. At that point, that's personal and it's not deductible. But if you actually made a sincere attempt to start your business and it just didn't get off the ground running and you actually put money into it, it's now a capital expense, and you can still claim it on your personal tax return, that loss, and you can deduct it. You can deduct up to $3,000. And if it's more than that, any additional loss that you can't use is carried forward in other years. So I really wanted to bring that up about startup costs, because if you don't remember to claim it 6 months from when that return is due for the year that you open it up, like from the year, um, you could possibly lose those startup costs for, like, that's it, it's done. You can go back and amend it, and that takes some time, but don't play with that. Like if you, that's why I try to tell you guys, if you've already started your business and it's been some time, definitely get with me or whomever you trust to go ahead and talk about what's the deadlines that you could possibly go back and amend. If you haven't started your business, just remember that the year that you decide to say I'm open, make sure that you include all of your startup costs when you submit all your information for your return, so that way you don't leave money on the table. So biggest thing of everything, always keep good records. There's no one particular special way to keep good records. It just needs to be something that you can retrieve, easily read, have the date, a description, the amount and who you paid, and typically what it was for. However you decide to keep that, as long as you can retrieve it later, if anyone ever needed to look at it, totally up to you. And as I've said throughout this whole thing, have a professional on your side. Have someone who specifies in tax. Don't just get any attorney if you decide to go the attorney route. Don't just get any CPA just because they're a CPA. All because they're a CPA does not necessarily mean that they are a tax professional. Enrolled agents are tax professionals, licensed tax professionals, and they specialize only in tax. So sometimes an enrolled agent, just don't go to them thinking like, well, they can do my books too. Some of them don't. So just know who you're working with and make sure that they're actually, for tax purposes, they are a tax professional. So we went through some of the questions, and that's my contact information if you guys do want to get in contact with me. So any questions? I'm going to get some water.
I think this is a lot of information for them to soak up right now. First of all, I really want to thank you, Shan-Nel, for going through this. This is very, very important. I'll tell you, every time you talk, I learn something new, learn something different, and it just makes me more motivated to make sure that I understand my tax situation. Let's just
Yeah.
say that. Because what you're going to find in doing the business, and I've been doing this a long time, is that as you transform, and like for me, I transformed from a sole proprietor to an LLC to going back to virtual, is that your business is going to shift, it's going to change, your financial situation is going to be different every single year. Sometimes you're going to need to have a professional do your taxes. Sometimes it might be small enough you can do it yourself. It's really all about making sure you do it right. Okay, that you do it right, that is accurate. Because what you don't want Is somebody like Shan-Nel from the IRS come down here and ask you for your paperwork, right? Okay, so we lucky she don't work for the IRS no more, but I'm just saying, but you don't want to be audited, okay? And in any given time, you don't want to be that business that have to sit there and justify why you spend everything on have something. You want to make sure you have good records. And even if you are audited, you still want to make sure that you have all your records in order because you can't control that part. If they decide they want to audit you, it's going to happen, right? But you want to make sure that you do it right the first time and have that worry-free stress off of you that your taxes are done correctly, right? So that's really what I wanted to stress here. So all the points that she made, again, this is going to be recorded. And also going to reiterate this, that I started a new Facebook mentoring group, and I'm also doing something on my website so that you as a student are an automatic member that you can go back in here and you can review this video to keep you abreast of what's going on. And again, Shan-Nel is going to be available if you want to talk to her personally about your tax situation. She is a resource for you. Everyone that I brought into this course have worked with me for a couple of years. They've done this presentation numerous times already. Shan-Nel is great at it. She's really good at what she does. And if she cannot help you, I'm pretty sure that she could refer you to someone who can help you on whatever level that you're on. Don't feel that, that you don't have the right person. That's one of the perks of this class is that we're doing the work for you. We're providing the resources for you. So make sure that you take down her information. If you don't get it here, I would definitely post her information in the class. And matter of fact, I think I'll go back and actually add Gina's information in the class so that if you wanted to talk to her, if you haven't downloaded her 10 Truths of Entrepreneurship, make sure you do that. And, always, always, always don't be afraid to ask questions or stuff like that. Okay. So does anybody have any questions? Now we can sort of unmute our mics and you can just go ahead and ask questions. We'll do that
Right.
for a few minutes and then we'll have to take a break and move on with the rest of the lecture.
I have a question.
Mhm.
All right, I know you said as far as like the LLC, you go ahead and file your taxes as as for the business. But how do I incorporate, like, do I do that and I also do a personal tax? I know you said something like that because I have kids. So how do is that separate or how do I break that tax down?
No. So
How
what
is
ends
that
up,
tax?
yeah, so this is why I love when this kind of presentation is in person, because when you see the whole package together, like physically see it together, you'll understand. You filed a tax return before, correct? Okay. So you know that you get the 1040, right? Like the 1040 package, and there's a whole bunch of forms in there, right?
Right.
That form I just showed you, that was the Schedule C, it would just be one of the many forms that would be in that package.
Okay.
So it's literally a part of your 1040 package. It's a part of your personal return.
So
It's just another form.
in one is not anything separate. Okay.
And then what happens is like I had showed you that bottom number where it showed, well, in my examples, it had net earnings, but you could have net losses too. All it'll do is just like how any of your other forms in that packet, where it'll have the computation and then that bottom number will go back to the front of that 1040 return. Same thing for the business. It will just go right back to the front of the beginning of the return and then go from there. So it's just all a part of your personal.
Okay.
So when you're doing your taxes on your own, like say for instance, do TurboTax, free edition, the same because basically you're just copying what's on your W-2s and inputting online. It's the same thing. They would just have a category like, if you have a business.
I can't speak for TurboTax.
Oh, okay.
You would need to call
I'm
their
just
customer
saying.
service.
I'm just saying about the forms.
Yeah, I will say that TurboTax do have, I use TurboTax and I will say that there are versions of TurboTax that will have either just your own personal or they'll have a combination of your personal and business. For the ones that I've used where I wasn't really making a whole lot of money, I've used the TurboTax where it had the business component, and that's where you will add your business pieces to it, and then it will sort of automatically calculate it. But we could talk about that outside of this lecture here.
Yeah.
Okay.
Yeah. Mhm.
Any other questions? Now's the time.
I'm pretty sure they will. But, but again, you guys have our email address. You definitely have mine. If you have any other burning questions, and I'm pretty sure they will, Chanel, as we go through, because the next lecture we're going to have after the break is we're going to talk about business structure. And I
Yeah,
think once they understand the business structure and
this
what that,
will all make sense.
it'll all click
It'll
in. And
click.
they'll be like, oh, now I know what she's talking about.
So, and I real quick, I do want to give you guys this last burning tip for particularly this year. For any of you who've received 1099s in the past, as independent contractors, freelancers, whatever, from people who've paid you, the form will be a little different this year. It's going to be called a 1099 NEC. It's for non-employee compensation. That's what the NEC stands for. It's not going to be the 1099 MISC, the miscellaneous. So it's the same form. So for those of you who are used to getting it, that's what that form is. Do not disregard it and say like, oh, I don't know what. That's the person who you've worked with showing you your income that they paid you. Now, if you don't receive a 1099, this is just in general from people you've worked with and they've paid you, as a business, you are still required to report that income. So if it hit your Venmo, if it hit your Cash App, if it hit your PayPal, because I know how you guys get down. Outside of your business accounts or your personal accounts, however you're doing it, because remember, today we're going to try to separate business from personal, but whatever you were doing to receive money, you need to make sure you report all of your money, however you received it, cash in hand too.
Mhm.
Okay, so
Yeah,
just
you
make
would
sure
get
you do
that 10,
that.
yeah, you would get that 10 if you have a business prior to this class or you tried to operate your business and you had to turn in a W-9, okay? Because they paid you more than X amount of dollars. You might receive that 1099 form that she's talking about.
Right. So, but even if you don't, this is just in general, even if you don't receive a 1099 as a business owner now, it is on you to make sure you are reporting your business. And I'm explaining to you why, just in general about tax returns as a business owner. Your tax return is more than just, okay, how much do I owe or how much am I going to get back? It is a legal document. There's a reason that banks, um, registration departments and licensings and certifications will ask for your tax return. It is a great snapshot of the activity of your business. It's a good way for you too to kind of keep track of, if you don't necessarily keep formal records, especially like a lot of people when you're first starting out, it's a great way for you to kind of get a snapshot of what you did for the year. Not everything, but a good snapshot though of what your business did for the years, how much money you brought in, a general idea of how much money went out. And that way you can kind of keep track. For those of you who will always be trying to say, okay, I've been in business for 5 years, but you've only filed the last 2 returns, there's now a disconnect and there's nothing to prove it other than your word, unless you registered somewhere. So, your tax return is a legal document, is proof of your business, is a wonderful way of keeping track of your activity, and it's a great way for you as a boss to be able to have a wonderful quick snapshot of the activity of your company to make some decisions. So,
Have a sole, how do you say a proprietary?
sole proprietorship.
Oh, so I have to work on that one. But I'll
That's
just say
okay.
so. Do you keep receipts like I know some people say, oh, keep the gas receipts when you go through the tolls. Do all of those really count?
Yes, because what we do now as business owners, you're going to compare. Now, I will say this: if you know that your mileage probably will add up more than what you're probably putting in the tank of gas, because remember, the tank of gas should only be for what you're using for business purposes. So not the whole tank, and you had one trip, but the rest of the tank was used, for
Oh, yeah.
commuting your job and personal, whatever. But if you are truly filling up that tank, because let's say we're here in Maryland and you're driving down to say North Carolina, and then you're coming back, then that's a different scenario, and you want to maybe keep that receipt for sure. Every time you go through the toll plaza though, and it's for a business purpose, you definitely want to keep those receipts, because whether you take mileage or not, um tolls and parking, they're expenses outside of the car, and you can still deduct them.
What about groceries?
What that would
Well,
depend upon what you're doing.
What
If
type
it's
of
if it's
business? Okay.
yeah,
yeah.
if it's your personal groceries, absolutely not. But I mean, if you're like a daycare,
So like if I bought food for like my open house events or my round tables. And so I
right,
would take that food that I purchased, that I fed people that came to the event, and I had
right,
it on.
Okay.
right. And then with food, that's why I said that's why I was talking about earlier when I said it's a good snapshot. Food is one of those weird ones where you're only going to see 50% of it on the return because
Okay.
only 50% of it's deductible.
Okay.
So that's why I say it's a good snapshot. Sometimes it's not going to be 100% accurate just because of how tax law treats it in comparison to, the financial rules.
Okay,
But
so we got one last question from
yeah,
Pamela.
yeah,
Yeah,
Pam.
okay.
Yes, hi, thank you. I had a question regarding using a home office. Is there
Okay.
any implication with the IRS if we use like one room of our home?
No, absolutely not. I'm happy you brought that up, Pamela. That's a great question. No.
Thank you.
It's literally the space that's designated. It has to be exclusively.
Like right here, like this is like
Yes.
20 square feet of my house.
Yes.
That's my taxable, that's
Right.
that I'm gonna.
So like for me, I actually use this whole room. but if I wanted to get real technical, I could say like where my desk is right now and say like if I actually use the entire room. But if I was like, let's say someone else where they're just their desk and they have like a filing cabinet and that space is used only for their business activity, then it's that space. Or if you have like your desk here and let's say you have products that are stored maybe in a portion of your basement somewhere or in a shed or wherever the case. So it's the square footage of whatever space that you use exclusively for your business. And
Now, one thing you want to
What's
be
your
mindful
rent?
when you designate the space for your home business. One thing you definitely have to be mindful of is that whatever county you're in or whatever subdivision you're in, you will be paying taxes on the use of that space. So I get a bill every year that says, Miss Austin, we assess the amount that you put on your business taxes to equal up to $200 for the use of your home business in this county as part of county taxes that I have to pay. Like any other business that have a brick and mortar, they get a county tax bill. I got one when I had an office, and then I got one because I got a home office. And then you're responsible for paying that county tax bill. If you don't pay that county tax bill, you're going to keep getting bug letters and eventually get in trouble. You don't want to get in trouble. So you pay it just like you pay any other tax bill that you would get.
yeah, the property one that you're talking about from the county, that's that personal property tax. So that it goes beyond just the home office space. That's about like supplies and equipment and other
Yeah.
things too. So
Yeah.
it's a full assessment of the things that you're using for your business, and it's
Right.
coming from the county and or city, depending on where you are. But yes, Pamela, it's based off of the square footage, and it has to be exclusive. So for those of you who are my dining room entrepreneurs, if the dining room is used exclusively for your business, and I think that is, I really wish I had like a whole dining room set up where I did not need, we actually use our dining room table. But if I didn't, I've saw some people who have beautiful home offices and they have their dining room set up exclusively for just their home office. If that's what you're doing, then bravo. You're not, you have a desk in there, all that room is exclusive. But if in fact that dining room table, you use it to do your work, and then on occasions you guys are eating, the key word is exclusive.
Exclusive.
So now you have used it for multiple purposes. It's not exclusive. Now, if you put a desk in your dining room with it, or turn the dining room table, into your office or whatever, and then, I guess what you have, it has to be exclusive for your business. So think of that, the space used solely for your business. The minute that you start to commingle it, that's when it becomes, as far as tax purposes, they'll say, nope, you can't deduct it because it has a personal use to it.
Okay. All right. So this has been great. Kim Marie, we're going to cover that bookkeeping stuff because that's outside of the scope of this lecture for Shan-Nel. But Shan-Nel, I want to thank you so much for coming out here.
You're welcome.
This has been, I know we can go on all day with questions. We're getting excited, but what I want to do is I want to reel everybody back and let's really talk about the business structure, because you can't, none of this stuff that we're talking about is going to apply to you until you know what business you're going to deal with.